In 1842, China was forced to sign the Treaty of Nanjing after a devastating military defeat against the British Empire. The terms were not just harsh, they were humiliating. China had to pay massive reparations, open key ports to foreign control, and surrender Hong Kong for the first time in centuries. An ancient civilization that had seen itself as the center of the world was forced into a system designed and controlled by others. That moment marked the beginning of what Chinese historians later called the Century of Humiliation, a long period during which foreign powers extracted wealth, dictated trade conditions, and imposed financial and political influence through military superiority and economic leverage. But history has a strange way of bending back on itself. The country that was once coerced into opening its markets at gunpoint eventually learned the deeper mechanics of power, not just how empires dominate with weapons, but how they dominate with currency, trade systems, and debt. Today, China is one of the largest foreign holders of U.S. Treasury securities, holding hundreds of billions of dollars in American government debt. The symbolism is powerful. The nation that once paid indemnities to Western powers now lends money to the most powerful economy on Earth. This reversal is not accidental, and it is not just economic. It is the result of decades of strategic positioning inside a financial system the United States itself helped build. To understand how this transformation happened, we have to move forward in time to one of the most important turning points in modern financial history. In 1971, the United States made a decision that changed the structure of global power. President Richard Nixon announced that the U.S. would no longer convert dollars into gold. Until that moment, the world operated under a system where currencies were tied to the dollar, and the dollar itself was backed by gold reserves. This created confidence. The dollar was not just paper, it represented a claim on something tangible. But by the late 1960s, the United States was spending far beyond what its gold reserves could support. The Vietnam War, domestic social programs, and rising global commitments had flooded the world with dollars. Foreign governments began demanding gold in exchange for those dollars, and American reserves were shrinking. Nixon's decision ended the gold standard and introduced a new reality. The dollar would now be backed not by gold, but by trust, by the credibility of the U.S. government, and by the size and strength of the American economy. This move gave the United States extraordinary flexibility. It could run deficits, finance spending, and expand credit without being constrained by a fixed supply of gold. But this new system created a dependency that few fully understood at the time. If the dollar was no longer tied to gold, it needed another foundation to maintain global demand. That demand came from trade, energy markets, financial stability, and the sheer scale of American capital markets. Countries needed dollars to buy commodities, to participate in global trade, and to store value in what was considered the safest financial system on Earth. Over time, this produced a powerful cycle. The United States imported goods from around the world and paid in dollars. Those dollars accumulated in foreign economies. Instead of sitting idle, they were reinvested into U.S. financial assets, especially government bonds. This meant America could finance its spending by issuing debt that other countries were willing to buy. The system reinforced itself. The more the world traded with America, the more dollars circulated globally. The more dollars circulated, the more demand existed for safe dollar assets. And the safest asset was U.S. Treasury debt. This architecture made the United States not just a superpower in military terms, but the central hub of the global financial system. For decades, this arrangement appeared almost unshakable. American consumers enjoyed access to cheap imported goods. The U.S. government financed deficits at relatively low cost. Global markets relied on the stability and liquidity of American financial instruments. But beneath this apparent stability, another story was unfolding. A country that had once been economically marginalized was quietly integrating itself into this dollar-based world and learning how to operate inside it. China, emerging from decades of economic isolation, began transforming itself into a manufacturing powerhouse. It exported goods on a massive scale and received payment in dollars. But instead of allowing those dollars to flow freely, China accumulated them as reserves. Those reserves needed a destination, and the most reliable place to park them was U.S. Treasury bonds. This process was not about ideology or confrontation. It was about survival, growth, and strategy. China used the system as it existed, benefiting from global trade while building industrial capacity at home. Over time, this created a feedback loop. Americans bought Chinese goods, China accumulated dollars. Those dollars were invested back into U.S. debt. The U.S. government used borrowed funds to sustain spending and consumption, which in turn supported continued imports. It became a circular relationship where production, consumption, and credit fed into each other. At first, this relationship seemed beneficial for both sides. American consumers gained access to affordable products. China lifted hundreds of millions of people out of poverty through industrial expansion. Global markets stabilized around predictable trade flows. But as the scale increased, so did the implications. The United States was becoming more reliant on foreign financing, and China was becoming one of the key participants in that financing. This was not a story of domination, but of entanglement. China's rise as a major holder of American debt reflected not control over America, but participation in a system America had designed. The real shift was psychological and structural. For the first time in modern history, the leading economic power was also deeply indebted to a strategic rival that had mastered the very mechanisms of global finance that once marginalized it. The deeper lesson is that power does not only move through armies or diplomacy. It moves through production, trade balances, and financial flows. The United States built a system that allowed it to project influence through currency and markets. China entered that system, learned from it, and used it to accelerate its own rise. And now the world is living inside the consequences of that interaction.
The transformation of the dollar into the central pillar of global finance did not happen overnight, and it was not sustained by confidence alone. After 1971, when the United States ended the convertibility of the dollar into gold, a new era began, an era where American power depended less on tangible reserves and more on economic scale, institutional credibility, and global interdependence. The dollar survived the end of the gold standard because it was embedded in something far larger than metal. It was embedded in trade in oil markets, in banking systems, and in the vast network of U.S. financial institutions that provided liquidity and perceived safety. Over time, this structure evolved into what many analysts describe as the dollar system, a framework in which global commerce, especially commodities and energy, relied heavily on dollar settlement. Countries that wanted access to global trade accumulated dollars. Those dollars had to be stored somewhere. The most attractive destination was the U.S. Treasury market, the deepest and most liquid government bond market in the world. U.S. Treasuries were considered low-risk, highly tradable, and backed by the taxing authority of the largest economy on Earth. This created a powerful loop. The United States could run trade deficits, importing more than it exported, because foreign partners were willing to accept dollars. Those same partners often reinvested their surplus dollars into U.S. government debt. In effect, America consumed goods from abroad and paid with financial assets that were widely accepted as safe. This arrangement lowered borrowing costs for Washington and allowed the U.S. government to finance spending at a scale that would have been difficult under a gold-backed constraint. But this structure also required cooperation from surplus nations. And by the late 20th and early 21st century, one country stood out as the most significant surplus partner of the United States: China. China's economic rise accelerated after market-oriented reforms and its integration into global trade networks. Factories expanded rapidly along the eastern seaboard. Manufacturing capacity surged. Labor costs were competitive. Exports exploded. As China sold increasing volumes of goods to American consumers, it accumulated vast amounts of dollars. These dollars became part of China's foreign exchange reserves. Managing those reserves required careful strategy. Simply holding cash would expose China to currency fluctuations and inflation risk. Investing in riskier assets could threaten stability. U.S. Treasuries, by contrast, offered liquidity and relative security. As a result, China became one of the largest foreign holders of U.S. government debt. This was not an act of generosity, nor was it a political favor. It was a structural consequence of the trade imbalance and China's desire to maintain export competitiveness. By purchasing treasuries, China recycled its dollar earnings back into the American financial system. This helped keep U.S. interest rates lower than they might otherwise have been, supporting American consumption and government spending. The relationship appeared mutually beneficial. The United States gained access to inexpensive imports and steady financing. China gained industrial growth, employment, and rising living standards. Yet beneath this cooperation lay a deeper complexity. The scale of China's treasury holdings began to spark debate within the United States. Commentators questioned whether dependence on foreign creditors posed a national security risk. Some asked whether China could use its holdings as leverage in times of political tension. The idea that a foreign power might own a large portion of American debt created psychological discomfort. However, the reality was more nuanced. US Treasuries are denominated in dollars, a currency the United States itself issues. While large-scale selling of bonds could disrupt markets temporarily, it would also reduce the value of China's own remaining assets and potentially destabilize global markets, harming Chinese exports. This mutual exposure limited the practicality of aggressive financial action. The bond relationship was less a weapon than a shared vulnerability. Both nations were deeply integrated into a single financial ecosystem. If one side destabilized the system abruptly, the consequences would not remain contained. Over time, the dynamic became clearer. China's holdings of treasuries were both a sign of strength and a reflection of dependency. On one hand, they demonstrated China's accumulated surplus and financial capacity. On the other hand, they revealed reliance on the stability of the dollar system. As geopolitical competition intensified in areas such as technology, trade policy, and security, the financial link remained a stabilizing anchor. It was difficult for either side to escalate conflict without considering the broader economic consequences. Meanwhile, domestic debates intensified in both countries. In the United States, concerns grew about persistent budget deficits and rising national debt. Political leaders disagreed on fiscal priorities, but borrowing continued. In China, policymakers evaluated the risks of holding large quantities of foreign debt, particularly as global interest rates shifted and economic growth patterns evolved. Gradually, data began to show a reduction in China's treasury holdings from peak levels. This was not a sudden withdrawal, but a measured adjustment. Diversification strategies emerged, including increased gold purchases and expanded investment in other assets. Yet the dollar remained central. The US Treasury market remained unmatched in scale and liquidity. Global investors still turned to it during times of crisis. The system, though evolving, persisted. What became undeniable was the depth of interdependence. The United States relied on global confidence to sustain its borrowing model. China relied on global trade and stable financial markets to sustain its export-driven growth. The bond market sat at the intersection of these realities. It symbolized a world where former adversaries were economically intertwined. It illustrated how modern power is often exercised through supply chains and balance sheets rather than cannons and conquest. And it set the stage for a broader strategic question. If both nations are locked inside the same financial architecture, how do they compete without collapsing the structure that supports them both? By the time the global financial crisis erupted in 2008, the depth of the US-China financial entanglement was no longer theoretical, it was undeniable. What made the crisis so revealing was not just the collapse of major American financial institutions, but the reaction of global capital. Conventional logic might have predicted that confidence in US assets would collapse, that foreign creditors would retreat, and that the dollar would weaken dramatically. Instead, the opposite occurred. In the midst of panic, investors around the world rushed into US Treasury bonds. Yields fell. Demand surged. The dollar strengthened. The very country at the epicenter of the crisis remained the anchor of global liquidity. This moment exposed a critical reality. The dominance of the dollar system was not merely about economic performance, but about institutional depth, legal infrastructure, and market scale. Even when Wall Street faltered, there was no immediate substitute large enough to replace US financial markets. For China, the crisis was a strategic lesson. Beijing watched as Washington deployed unprecedented monetary stimulus, expanded the Federal Reserve's balance sheet, and injected liquidity into the system at historic levels. The United States demonstrated that, because it issues debt in its own currency, it possesses extraordinary flexibility during emergencies. It can expand money supply, purchase its own bonds indirectly through central bank operations, and stabilize markets without relying on foreign currency reserves. For China, which held hundreds of billions of dollars in treasuries, this raised an important question. What happens if the value of those assets is diluted through inflation or currency depreciation? The crisis highlighted the asymmetric structure of the relationship. China was a major creditor, but it was a creditor within an American-controlled monetary framework. This meant that ultimate control over dollar liquidity and interest rate policy rested in Washington, not Beijing. While China benefited from the safety and liquidity of treasuries, it was also exposed to decisions made by US policymakers. That exposure reinforced a long-term strategic objective: reduce vulnerability without destabilizing the system. At the same time, the crisis deepened China's understanding of economic endurance. The United States survived the shock not because it was debt-free, but because the global system was structured around its currency. The more unstable markets became, the more central the dollar appeared. This paradox strengthened China's awareness that simply holding large quantities of US debt did not equate to control. Influence in financial markets is constrained by interconnected incentives. If China were to sell massive volumes of treasuries abruptly, bond prices could fall and yields could rise. But such an action would simultaneously reduce the market value of China's remaining holdings and risk triggering global instability that would weaken demand for Chinese exports. The supposed financial weapon was double-edged. This realization shifted China's approach from accumulation toward calibration. In the years following the crisis, China's treasury holdings fluctuated but gradually trended downward from their peak. This was not an act of confrontation. It was risk management. Official US Treasury data showed that by the mid-2020s, China's holdings had declined significantly compared to earlier highs, reflecting diversification rather than panic. The objective was not to provoke a collapse, but to create optionality. Diversification strategies included increasing gold reserves, expanding investment in strategic commodities, and promoting alternative trade settlement mechanisms. At the same time, China intensified efforts to internationalize its own currency, encouraging cross-border trade settlements in renminbi and building financial infrastructure capable of supporting transactions outside the dollar-dominated network. These steps were incremental. The dollar remained dominant, but the direction of movement suggested long-term repositioning. Meanwhile, the United States continued operating within its established fiscal patterns. Budget deficits persisted. Political polarization complicated long-term fiscal planning. Yet global appetite for treasuries remained substantial because the alternatives were limited. The Eurozone faced its own structural challenges. Japan's bond market was constrained by demographic and monetary factors. Emerging markets lacked comparable liquidity. The depth of US capital markets continued to anchor investor confidence. The dynamic between Washington and Beijing thus evolved into a delicate balance. The United States relied on foreign capital inflows to sustain low borrowing costs. China relied on the stability of the US financial system to preserve the value of its reserves. Both sides understood that abrupt disruption would be costly. This mutual awareness acted as a stabilizer, even as strategic competition intensified in other domains such as technology, supply chains, and security alliances. The relationship was no longer defined by simple creditor-debtor logic. It had become a structural interdependence embedded in global finance. Each country sought to strengthen its strategic position without triggering systemic shock. The United States leveraged its institutional dominance and network effects. China invested in resilience and gradual diversification. The contest was subtle, unfolding over years rather than days, and it raised a profound question for the future. Can a global financial system designed in one era adapt peacefully to the rise of a rival power within it, or does structural change eventually produce fracture? For years, headlines and political rhetoric have repeated the same dramatic claim: China owns America. The argument sounds simple and alarming. China holds hundreds of billions of dollars in US Treasury bonds. America is deeply in debt. Therefore, China has power over the United States. But reality is far more complex and far more interesting, because the truth is that this financial relationship is not a story of dominance. It is a story of mutual dependency, structural constraints, and the limits of economic leverage in a globalized world. On paper, China appears to hold a powerful card. It is one of the largest foreign holders of US government debt. If Beijing suddenly decided to dump its treasury holdings, the consequences could be severe. Bond prices would fall. Interest rates in the United States could spike. Borrowing costs would rise for the government, businesses, and consumers. The dollar might weaken. Financial markets could panic. It sounds like a financial weapon capable of destabilizing the world's largest economy. But this is where the illusion begins to collapse. Because selling the debt would hurt China almost as much as it would hurt America. The value of treasury bonds depends on demand. If China began selling large quantities, bond prices would drop immediately. That means China would be selling its assets at a loss. Hundreds of billions in reserves would shrink in value in real time. At the same time, a weaker dollar would make Chinese exports more expensive for American consumers. Chinese factories depend heavily on access to US markets. If demand falls, production slows. Jobs disappear. Social stability, a core priority for the Chinese government, comes under pressure. What appears to be leverage quickly becomes a self-inflicted wound. Economists often describe this situation using a Cold War analogy. mutually assured destruction. Just as nuclear powers could not strike each other without catastrophic consequences for both sides, the financial relationship between China and the United States creates a similar constraint. Neither side can move aggressively without triggering damage at home. China is not holding a weapon pointed at America. It is holding a fragile asset tied directly to America's stability. The more debt China holds, the more it depends on the health of the US economy. If America collapses financially, China does not win. China loses one of its largest export markets, sees the value of its reserves fall, and faces global economic chaos that would ripple through its own system. This is why, during the 2008 financial crisis, China did not abandon US debt. It increased its purchases, not out of generosity, but out of necessity. Beijing understood that stabilizing the US financial system was essential to protecting its own economic future. The creditor was forced to support the debtor. That is not dominance. That is entanglement. And yet, despite these constraints, the relationship still represents a profound shift in global power. For most of the 20th century, the United States was the world's largest creditor. Other nations depended on American capital. Today, the United States is the world's largest debtor. It borrows continuously to finance government spending and sustain consumption. This reversal changes how power operates. It does not give China control over America, but it gives China influence. And influence is often more subtle than control. Financial dependence shapes decision-making at the margins. Policymakers must consider the reactions of creditors. Markets react instantly to signals of instability. Global capital flows respond to confidence, not just force. Power in the modern world is less about commanding and more about shaping incentives. China understands this. Instead of attempting to weaponize its treasury holdings, Beijing has pursued a more strategic path: gradual diversification, increased gold reserves, infrastructure investment across Asia, Africa, and Latin America, promotion of the yuan in international trade, creation of parallel financial systems that reduce reliance on the dollar. These moves are not dramatic. They are patient, incremental, calculated. China is not trying to destroy the dollar overnight. That would be catastrophic for its own economy. Instead, it is preparing for a world in which the dollar is less dominant and alternatives exist. Meanwhile, the United States retains structural advantages that are often underestimated. The dollar remains the world's primary reserve currency. Global trade, commodities, and financial markets still rely heavily on it. US Treasury bonds remain the safest and most liquid financial asset on Earth. American capital markets are deeper and more flexible than any other. Innovation, technology, higher education, and military reach still give the United States enormous leverage. Power did not disappear. It evolved. What has changed is the nature of that power. It is no longer absolute. It is contested, negotiated, and shared within a system where rivals are also partners. China and America are locked in a relationship that neither can escape. America depends on Chinese manufacturing and financing. China depends on American markets and financial stability. Each side competes strategically while cooperating economically. It is rivalry embedded within interdependence. And this is why the phrase "China owns America" misses the deeper story. Ownership implies control, command, freedom to act without consequence. That is not what exists here. What exists is a financial ecosystem where both sides are constrained by the same system that empowers them. America cannot ignore its debt trajectory forever. China cannot unwind its exposure without destabilizing itself. The real power struggle is not about who holds the bonds. It is about who adapts faster to a changing world, who invests more wisely, who builds stronger industries, who maintains credibility. Because in the end, financial power is not just about lending. It is about confidence. And confidence is the most valuable currency of all. The real story is not that China owns America, and it is not that America is collapsing. The real story is that the global system that defined the last 70 years is slowly evolving into something new. Not through war, not through a single catastrophic event, but through gradual shifts in production, finance, and strategic thinking. The relationship between the United States and China sits at the center of this transformation. For decades, America was the unquestioned engine of the global economy. It produced, it lent, it consumed, and it set the rules. The dollar became the backbone of international trade. American institutions shaped financial markets. Washington influenced economic decisions across continents, but systems built on dominance eventually face pressure. Not always from enemies, sometimes from students. China studied how power works. It watched how the United States used economic strength after World War II. It saw how lending, trade, and industrial capacity created influence without direct confrontation. And it applied those lessons patiently, quietly, methodically. China did not try to replace the United States overnight. It focused on building factories, infrastructure, and supply chains. It accumulated reserves. It learned the mechanics of global finance. It positioned itself inside the system before trying to reshape it. This is what makes the current moment so significant. The shift in power is not explosive. It is structural. It happens in shipping lanes, trade agreements, currency swaps, and investment flows. It happens in who manufactures the goods the world depends on and who finances the deficits that keep consumption alive. China's gradual reduction of US Treasury holdings is part of this larger strategy. Not a dramatic break, but a careful recalibration. Beijing has increased gold reserves, expanded its Belt and Road infrastructure projects, and pushed for trade agreements that bypass the dollar. It has encouraged energy deals priced in yuan and strengthened regional financial institutions. None of these moves alone dethrone the dollar. But together, they signal preparation for a multipolar financial world. A world where the dollar is still dominant, but no longer alone. The United States, meanwhile, faces a different kind of challenge. Not an external attack, but an internal question. How long can a nation sustain its global leadership while borrowing trillions each year? How long can consumption outpace production? How long can political systems delay hard fiscal decisions without consequences? The danger is not immediate collapse. America still possesses unmatched advantages. Its universities lead global research. Its tech companies shape digital infrastructure. Its military reach remains unmatched. Its capital markets attract global investment. But strength does not eliminate vulnerability. History shows that dominant powers rarely fall because of a single blow. They decline when internal imbalances accumulate faster than they can adapt. And this is where the story becomes less about China versus America and more about time. Time favors those who plan long-term, who invest consistently, who build capacity instead of relying on momentum. China has demonstrated patience. It tolerated slower consumption, lower incomes, and strict controls to build industrial strength. It accepted decades of gradual progress instead of immediate gratification. America has often chosen the opposite path. Faster growth now, borrowing against the future, trusting that innovation and resilience will solve problems later. Neither approach guarantees victory. Both carry risks. China faces demographic decline, rising debt within its own system, and political constraints that may limit innovation. America faces fiscal pressure, infrastructure gaps, and increasing political division. The future is not predetermined. The financial entanglement between these two giants will shape the coming decades. Not because one will destroy the other, but because both must navigate a world where dominance is no longer absolute. Cooperation and competition will coexist. Trade will continue even amid geopolitical tension. Technology, energy, and finance will become new battlegrounds. And at the center of it all remains the question of confidence. The dollar remains powerful because the world trusts it. Investors trust American institutions. Markets trust the legal system. Allies trust security guarantees. But confidence is not permanent. It must be maintained, built, reinforced. The same applies to China. Its rise depends on credibility, on whether other nations trust its currency, its markets, and its leadership, on whether it can transition from being the world's factory to being a financial anchor. The coming decades will not be defined by who holds more debt, but by who builds more trust. Because financial systems ultimately rest on belief. Belief that debts will be honored, that currencies will hold value, that economies will grow. Remove that belief, and the system shakes. Strengthen it, and influence expands. This is why the story of China and America is not one of victory or defeat. It is a story of transformation. A story of a world moving from a single dominant power to a balance of competing strengths. The United States is not falling. China is not unstoppable. Both are adapting to a new reality where economic power is shared, contested, and constantly renegotiated. And perhaps that is the real lesson of history. Power never stays still. It shifts with production, innovation, discipline, and time. The British once ruled global finance. Then America replaced them. Now the system is evolving again, not into collapse, but into complexity. A world where influence flows in multiple directions, where rivals are also partners, where the future is shaped not by a single empire, but by interconnected giants learning to coexist. The story is still unfolding, and the decisions being made today in Washington and Beijing will echo for generations.